The money sitting in your bank account isn't real in the way you think it is. That's not a metaphor, and it's not some fringe theory. If every customer decided to withdraw their cash tomorrow, the entire banking system would collapse within hours, simply because the money isn't actually there. This isn't a bug in the system, it's the system itself. A centuries-old design so deeply woven into our world that we've come to accept it as normal. It's called fractional banking, the hidden engine driving global debt, inflation, and the illusion of wealth. Once you understand how it operates, you'll see that our entire idea of money is built on promises that can never fully be kept. To see where this all started, we need to travel back to a world long before digital balances and banking apps. In medieval Europe, real money meant gold and silver. The wealthy stored their fortune in coins, gemstones, and precious metals, wealth you could hold in your hands. But carrying large amounts of gold was risky. Robbery was common and safety was never guaranteed. So people began entrusting their treasure to goldsmiths, craftsmen who also kept secure vaults. In return, the goldsmith handed out a receipt, a written promise that the holder could come back at any time to reclaim their gold. Over time, people noticed those paper notes were just as useful as the metal itself. They began trading the receipts directly, since each one represented real value and was far easier to carry than heavy bags of coins. This is where the real trick began. The goldsmiths made an observation. Hardly anyone ever came to collect their gold at the same time. Out of 100 customers, maybe 1 or 2 would withdraw on a single day. That meant most of the gold just sat there, untouched and idle. So the goldsmiths got inventive. They started issuing more receipts than the amount of gold they actually held. If they had 1,000 coins in their vault, they might print 2,000 receipts. Those extra slips could then be loaned out with interest, generating profit from gold that didn't even exist. As long as depositors didn't all show up demanding their coins, the illusion held together. It was the first time money had been created out of nothing, an invisible wealth built on confidence alone. What began as a clever trick soon turned into a revolution. Once people started treating paper claims as equal to gold, money was no longer tied to anything physical. The concept of value had officially broken free from reality. From this practice, banks were born, formal institutions built on the same foundation of trust and illusion. By the 17th century, even governments had adopted the model. The Bank of England was established in 1694 not as a public service, but to solve a royal crisis. The crown was buried in debt from constant wars. The bank lent vast sums to the government, far more than it actually possessed, in exchange for steady interest payments. Those debts weren't paid with gold from new conquests, but through the taxes of ordinary citizens. And if that sounds familiar, it should. It's the very same system nations still use today, borrowing money that doesn't exist and charging future generations the bill. The United States eventually adopted the same system. Early American banks issued paper notes that could, in theory, be exchanged for gold. But it didn't take long for them to realize they could print more notes than the gold they actually had in their vaults. Every so often, the illusion unraveled during what became known as bank runs, moments when frightened depositors rushed to withdraw their savings, only to find there wasn't enough gold to go around. One panic after another wiped out entire banks overnight. Yet rather than dismantle this fragile structure, the government decided to reinforce it. They created central banks to act as a safety net for the system. The message to the public was unmistakable. Even if the money isn't real, we'll make sure you keep believing it is. To understand how this operates now, let's translate it into modern terms, because fractional banking can sound almost like magic. Picture yourself walking into a bank and depositing $100. You assume that money stays in your account waiting for you to use it, but in reality, the bank keeps only a small fraction in reserve. Traditionally, that might have been 10%, keeping $10 and lending out the other 90. Someone borrows that 90 to buy something, and the seller deposits it into another bank. That second bank holds back 9 and lends out 81. The process repeats again and again. By the time it's all done, your original $100 has expanded into nearly $1,000 circulating through the economy. But here's the catch. Only the first $10 exists as actual cash. The rest is created through debt. Every new dollar in the system begins life as a promise to pay it back with interest attached.
If you thought that was shocking, brace yourself, because that version of banking is already outdated. In the United States today, banks are no longer required to keep even a fraction of deposits in reserve. Since March 2020, the Federal Reserve dropped the reserve requirement to 0. That's right, banks don't need to hold a single dollar in backup for the money they take in. The old idea of a 10% rule is gone. So what keeps banks from lending endlessly and creating infinite credit? The answer lies elsewhere. Today, lending is limited not by reserve ratios, but by another set of global restrictions known as capital and liquidity rules, collectively called the Basel Framework. The Basel Framework was born out of financial chaos, especially after the 2008 meltdown, crafted by a network of central bankers and regulators who gather in Basel, Switzerland, at the Bank for International Settlements. Think of it as the central bank of central banks. These rules aren't debated in Congress or voted on by the public. They're designed behind closed doors by unelected technocrats. Here's the gist. Banks must prove they have enough real equity, their own money, to cover possible losses. For example, if a bank wants to issue a risky $100 loan, it might need to set aside $8 of shareholder capital as a cushion. The riskier the loan, the bigger that safety margin must be. On top of that, banks must maintain enough liquid assets like cash or government bonds to survive a sudden crisis. In theory, these rules are meant to keep banks from soaring too high and crashing back to earth. Here's the key shift. Banks no longer lend out deposits. They create money when they lend. Every time you take out a mortgage or a business loan, the bank isn't handing you someone else's savings. It's generating new money on the spot by typing numbers into your account. That balance becomes real because you've promised to repay it. Only after issuing the loan does the bank check if it holds enough capital to back the risk. In today's system, over 90% of all money in existence isn't printed by the central bank. It's digital credit, created by private banks through lending. So when you look at your account balance, you're not seeing Federal Reserve money, you're seeing bank money, money that exists purely because of debt. As long as borrowing continues, the money supply expands. But when loans stop being repaid or new credit dries up, the illusion begins to crack. Every financial crash at its core is a crisis of trust in that illusion. This system leads to three unavoidable outcomes. The first is inflation. Because banks constantly expand credit, more money chases the same goods, eroding the value of every dollar. Prices rise not only because of market forces, but because each new loan waters down the currency itself. The second is endless debt. Since every dollar begins life as a loan, there's always more debt than actual money to repay it. Interest guarantees that someone, somewhere, must keep borrowing just to keep the system alive. And the third is power, concentrated in the hands of banks and governments. Banks earn interest on funds that were never real to begin with. Governments use this mechanism to fund wars, welfare, and bailouts without directly taxing citizens. Meanwhile, the wealthy, those who hold assets like property, stocks, and commodities, see their wealth rise with inflation, while ordinary workers watch their paychecks buy less each year. When the engine of the system stutters, the illusion begins to collapse. Take the Great Depression, for example. In 1929, banks had issued far more credit than they could ever redeem, fueling a frenzy in the stock market. When fear took hold, people rushed to withdraw their savings, only to discover their money was mostly imaginary. Thousands of banks folded in a matter of months. The same story repeated in 2008. This time, banks had inflated credit through complex mortgage securities, building a housing bubble on a foundation of overextended promises. When borrowers began to default, the whole structure started to crumble. Once again, governments and central banks rushed to the rescue, creating trillions of new dollars to prevent a total meltdown. They didn't fix the illusion, they saved it. Because without that illusion, the global economy would grind to a halt. To see the full picture, you have to zoom out. In the United States, reserve requirements are now zero. Across Europe, the UK, Canada, and Australia, they've long been reduced to mere formalities. These nations all operate under the same global standards, the Basel Framework. Meanwhile, countries like China, India, and Brazil still maintain traditional reserve ratios, often well above 10%, using them as tools to guide lending and control credit expansion. Yet even in those nations, Basel's capital and liquidity rules remain the ultimate authority, determining how much risk banks are allowed to take. Wherever you are on the planet, the true limit on money creation isn't what's sitting in a vault. It's the regulations drafted in Basel, Switzerland, by people you'll likely never vote for or even know exist.
Here's the harsh reality. The financial system needs you to stay in debt. If every individual and business suddenly paid off all their loans, the entire money supply would implode overnight. Banks would have nothing left to lend, and economic activity would freeze. The whole structure survives only as long as people keep borrowing, spending, and believing the numbers in their accounts represent tangible value. You are the engine that keeps the illusion running, both the source of its fuel and the guarantee behind its promises. This pattern isn't new. It's the same old trick, simply modernized. What the medieval goldsmiths once did on a small scale has evolved into the very backbone of today's global economy, and the risks haven't gone anywhere. Bank runs in the 1800s, the Great Depression of the 1930s, and the financial meltdown of 2008 all tell the same story. When trust collapses, the entire system teeters on the edge. Yet every time, the response is predictable. Print more money, patch the damage, and pretend stability has returned. The illusion is preserved, not repaired. So what lessons can we draw from all this? First, money itself isn't real wealth. True wealth lies in things that hold lasting value: land, resources, skills, and self-sufficiency. Second, debt is not harmless. It's the lifeblood of a system designed to enrich lenders, governments, and asset owners while draining ordinary people. And third, inflation isn't an accident of policy, it's built into the design. Each year, your purchasing power quietly slips away, forcing you to work harder just to maintain the same standard of living. Does this mean everything is doomed? Not at all. But it does mean you need to change how you think about money itself. Keeping savings in a traditional bank account won't shield you from inflation or instability. Blind faith in the system won't buy you freedom. The only real protection lies in building tangible wealth, assets that hold value outside the endless loop of credit and debt. The goal isn't fear, it's awareness. Because if every dollar begins its life as debt, then true independence starts by stepping outside that system and reclaiming control over what you own. History may not repeat word for word, but it always hums the same tune. The goldsmiths of the Middle Ages, the bank collapses of the 1800s, and the housing crash of 2008 all share the same pattern: money built on promises that outgrow reality. Each era believes it's different until trust finally breaks. And every financial crisis serves as a reminder. This system runs not on gold or real productivity, but on confidence. And confidence, once shaken, is the fastest thing to vanish. So the next time you check your bank balance, remember what you're really looking at. Numbers representing promises, not actual money. It's a system fueled by debt designed to serve those who understand it, not those who simply trust it. The moment you grasp the illusion, you gain the power to step beyond it. But if you ignore it, you remain a piece in a game where the odds are never in your favor. If this opened your eyes, make sure to subscribe, because history holds the roadmap, and together we'll follow where it leads.